Good day friends, welcome to Introduction to Accounting, which is based on NCERT Class 11 Part 1. Aim of these sessions, short sessions to give you an idea of accounting, and then we gradually build on the concepts. To decide the contours, the syllabus for Class 11 is of 100 marks, Financial Accounting Part 1 56 marks, Financial Accounting Part 2 24 marks, Project Work 20 marks. Total comes to 100 marks. Financial Accounting Part 1 will be based on theory and accounting process. Financial Accounting Part 2 would be based on financial statements of sole proprietorship. Project Work would be practical application of whatever you have learnt. With these contours, let us start with our session on accounting with very basic concepts which will help you build upon the same later. The terms of accounting, before you move further, you must know common terms which are used in accounting. Entity, the individual who starts the business is different from the business which has been started. It means that the personal transactions in the personal capacity of a promoter, for example, the school fees of the promoter will not form part of the business entity. For example, if he is running a garment shop, that particular school fees will not be taken into consideration while drawing the profit and loss account of that particular entity. This has important concepts which you will learn later on when we speak of legal entity concept, where a corporation is different from the promoters. The liability of the promoters is limited to the unpaid value of the shares in the legal entity. This encourages people to take up business ventures knowing the fact how much maximum liability would be there coming to them in case the venture does not succeed. Erstwhile, earlier, the liability was unlimited, and that really affected people. Their household items were sold off in case the business ran into trouble. The second important concept is transaction. In simple terms, these are the dealings that we enter into to make profit out of our business venture. At times, the transaction may even end up into losses. The third concept is voucher. As business complexities grow, there are so many aspects which touch upon a transaction. A purchase or sale may have income tax component, may have an indirect tax component. It may be backed up by some legal agreement which is there, and because of which certain conditions have to be fulfilled. So the person who is entering into a transaction has to fill up all those basic details in the form of a pre-printed form called as a voucher. This voucher, along with supporting details, will help the accountant record the transactions in books of accounts in a proper manner and then store the voucher for future reference, for audit, for government inquiries later on, say after 2 or 3 years of time. The fourth concept is the balance sheet, which records the assets and liabilities of a business. A balance sheet will have assets, for example, motor car, plant and machinery, etc. It has a continuing life, and the use of these assets will help the company or entity earn revenue or do sales and make profit. The entity, as it enters into business transactions, will also take upon itself liabilities. For example, it may purchase the goods on credit basis from its vendors. So the vendor is a liability to the business. A business venture will be started off by the promoter by putting in initial money. This is known as a capital. This is the initial fuel which kickstarts the business. As the business grows, as the business starts making profit, the promoter may withdraw some money from the business out of the profit, his share, and it is nothing but sort of a remuneration which a promoter gets for putting in efforts of starting the business, running the business. These are known as drawings. Goods are the items in which the business regularly deals in to make a profit. Unsold goods at the end of the year are nothing but stock and it forms part of the balance sheet. Customers to whom materials are sold are debtors. They are supposed to pay money to the business. Parties from whom items are purchased are known as vendors and they are supposed to pay money to the business. They are also called creditors. The fifth component is the profit and loss account components. They have a life of 1 year and they help you decide whether you have made a profit or loss in the business venture. The first concept is sales, when you sell goods in which you regularly deal in with the aim of making a profit. Revenue are earnings of the business which are not your day-to-day or not your core business. For example, you have some excess money and you place it with the bank in the form of a fixed deposit and earn interest. That is the revenue component. That is not the sale component, because selling is items in which you regularly deal in, while revenues are income from items in which you do not regularly deal in. For example, interest on fixed deposits or profit or loss on sale of fixed assets. Expenses are outflows that help you make sales or run the business. They are related to your sales efforts and they help you decide whether you have made a profit or loss at the end of the period. Expenditure will include even capital items. For example, when you purchase fixed assets, it has a continuing life and that is known as a capital expenditure. It is different from expenses, which is a revenue item which usually has a life of a year's time, while expenditure have a life beyond 1 year. For example, fixed assets, motor car, etc. Profit is excess of your sales over your expenses. They are a parameter which shows whether your business has made profit, whether it is profitable, or it has made a loss where your expenses are more than your sales. Gain is something which you earn not from your day-to-day or your core business activities. For example, I sell a fixed assets at a profit, that is known as a gain. Discount is something which I offer my customers when I make a sale on the face of the invoice itself, known as a trade discount, or I offer my customers to make early payments, which is known as a cash discount. So these are the components which are there, which an accountant or a person who is moving into accountancy field must be familiar with. More about all these things in our subsequent sessions. Till then, bye. Thanks.